Sorry, ladies and gentlemen, can you hear me now? One of my colleagues, clients, Bradley, you've just come through. Thanks for that. Sorry for the first few false starts. Usually have Brett on the other side sort of doing these sort of things. He's more of the tech guru than me, surprisingly, given the age. So if you just bear with me, we'll just kick start in another minute. A few more people just filing through. So just be a little bit, here we go. Can you all see me okay as well? And you can see the first slide, Australian Expat and COVID-19 webinar, just a raising of a hand or just a comment in that question box as well will help. Thanks, Stephen. Thanks, Kate. Thanks, Jennifer. Thanks, Amy. Thanks, Angelo. Thanks, David. Thank you all. All right, that's long enough. And again, apologies for the delay, a few false starts there, but thanks for joining today on another webinar provided by Atlas Wealth Management. Obviously today, running through just a general COVID-19 update on things, as well as trying to put a bit of an emphasis on how it relates to expats and managing your finances during a pandemic. Again, just some general housekeeping before we dive into it. I'll be looking to talk through a few general topics for about 30 to 40 minutes, sorry, and then we'll jump into a Q&A where we can address some questions there. With the Q&A, just be mindful, I can't give personal advice in this type of forum, just general advice, so general questions only if you can. We can talk more about personal advice off the side. For those of you out there right now doing it quite tough due to the pandemic, sympathies and thoughts to you all. We've seen a lot of expats that have lived and worked overseas for the last 5, 10, 15 years, and due to their residency being tied to their work visa, you know, they are having to uplift their whole family, uplift their lives and move back to Australia or try and move back to another country like Australia. So we really are feeling for you. Hang in there. Next slide, just going into a brief disclaimer. So before we delve into anything, as we are a licensed financial services firm, we just want to make sure that from a legal perspective, please treat today's presentation as mainly just an education session. Should not be construed as personal advice. All information is general in nature. So again, just an education session, not personal advice. Moving through, so who is Atlas Wealth Management? Well, Atlas Wealth Management, we're a leading provider of Australian expat tax financial advice. We've won multiple awards, both domestically and internationally, for the services that we provide. We are a registered and classified as a tax financial advisor by the Tax Practitioners Board in Australia, with clients in over 30 countries. Our specialty is providing advice to Australian expats, and right now, all of our financial advisors are degree qualified with numerous postgrad certifications. Atlas Wealth Management holds its own Australian financial services license, and we also have another firm, Australian Wealth Management, Atlas Wealth Management, sorry, based in the DIFC, so the Dubai International Financial Centre, where my colleague and friend Brett currently resides as well. So regulated by the DFSA, which just stands for Dubai Financial Services Authority. It's the equivalent of ASIC back in Australia. Moving through it, so who are Brett and James? So two gents with heads for radio, that's for sure. Brett Evans, he's obviously the founder and managing director of Atlas for the EMEA region, which is the Europe, Middle Eastern and Africa region. And I'm myself, I'm the managing director and look after the Asia Pacific and America region, APAC. As we go through today's agenda, please feel free to send through your questions that I will try and get to at the end. You don't need to wait till the end because I'll see them come through now. Today's agenda, we're going to be discussing what's been going on in the economy, given that we've just gone through another quarter. A bit of an update on tax residency, especially for expats, an update on super and what we're seeing is quite a common theme developing with retrenchments taking place, an update on the general Australian property market, as well as an update on general investing, shares, those sort of things, and then feeding into that Q&A at the end. Okay, well, diving into it, number one, economy. So at the moment, the economy, I mean, the Australian private sector economy fell back into decline during August to the latest flash PMI data, with business activity contracting following 2 months of solid growth. So we saw a good lift through June, July, and obviously pulling back throughout August, mainly caused by Victoria's obviously going to stage 4 restrictions. So that's what we've seen taking place. The recent survey also indicated a rise in spare capacity as sales and production requirements dropped, dampening the job market further. Prices, meanwhile, indicated rising inflation, pressures in part fueled by supply chain disruptions due to the new restrictions. This next slide, stating that the economy economic recovery has stalled. So as we can see in this graph, looking at a measure of the economy through the flash PMIs, we saw a contraction when obviously the pandemic was first announced and coming through. We can see that throughout February, March, April, May. We noticed obviously a slight expansion there in June, July, and then obviously more recently in August, another pullback, mainly caused by Victoria. Be mindful that because of this pullback in Victoria, following a surge in the new infections coinciding with business activity falling back into decline, when we reflect on Victoria as a state and its overall contribution to the Australian economy as well as GDP, we need to remember that Victoria holds the second largest share of the Australian economy, as well as it accounts for 25% of Australia's GDP, which is huge. So when we have a think about that, I suppose an additional consideration right now is how long will Victoria be in lockdown for, and what is the lasting effects of that on our economy and GDP? Recently in the news in the last few weeks, we saw Daniel Andrews, the Premier, sought to legislate the ability to keep Victoria locked down for up to 12 months. It's a scary thought, given the size of its contribution to Australia's economy, but that's what he's pushing for. We don't think that'll take place, and hopefully a vaccine is on the horizon as well. Moving on to the next slide, I might just reconfirm, everyone can hear me okay, they can see me, they can see the slides, just either dropping into that question box or just a raise of hands just to confirm that. Thanks guys, thanks for doing that, plenty coming through there. Okay, great. Moving into the next slide, just discussing the GDP. So GDP retracing as expected. So we're noticing a pullback in GDP growth. If we look on this graph, we see no surprise, contraction in GDP. Again, we see that Victoria contributing to at least 25% of the nation's GDP. It's no surprise, this graph, that there is a contraction there. With stage 4 lockdowns continuing, we're likely to see this trend continue. I suppose the big question at the moment is for how long. We know that the daily active cases in Victoria is starting to decline, but it is still quite high. And if we're going to see another second, third or fourth wave, what does that look like for Australia long term? At the moment, with the economic sanctions, I suppose, in terms of the stage 4 lockdown restrictions we're seeing, it's costing the Australian government about $1 billion per week. If we move over to the next slide, we'll have a look at what kind of hit the federal budget is taking. So at the moment, this graph, it just reflects the Australian government budget balance per cent of nominal GDP. As we can see there, it's going as far back as 1980, 1981. And it just goes to show right now, we really are in uncharted waters. People remember back in 87, as well as, I suppose, when we look at the GFC, 2008, 2009, it just goes to show the magnitude of this event that we're going through right now. If we are looking at, I suppose, how the economic event as a whole, it really is comparing back to World War II. We talk about it plenty on our expat chats on our podcast, but we really are in a situation where there's no real roadmap. We're making up as we go, but it's going to be interesting to see what takes place over the next 6 to 12 months as well. This next slide is just looking at the contributions to GDP growth. Now, at the moment, there are 3 main ones. Firstly, the mining industry. And I might just take a step back. This is coming from the March quarter 2020. Unfortunately, all of this data that we get from ABS, RBA, APRA, one thing we like about it, it is just raw data. There's no emotion in it. There's no subjectivity. It's purely objective, and therefore we can draw concise conclusions from it. Another item to remember is that, unfortunately, this is from March. And even though we only accessed it in the last few weeks, it just goes to show that there's a bit of a delay in actually receiving that market out to the public. However, based on the March quarter, this will act as a precursor of how the June quarter has performed, and therefore we can somewhat model on what we can expect going forward after that. Obviously, at the moment, the mining industry making up a little bit of, or an overall contributor to GDP, doing really, really well when we look at BHP and Rio, consistent returns there. Obviously, a major one, government, one of the largest contributors, given the size and contribution of the rolling updated stimulus packages that we've been seeing in the local economy. These are things like small business initiatives such as POIGs, GSTs, withholding, job seeker, job keeper packages. And lastly, obviously the major one being imports. Now, this isn't really a big surprise given, I suppose, the adapting workforce. A lot of individuals are now working from home, especially in the big cities, the main capitals. And therefore, when we reflect on this, this does lead to an increase in spending. People spending a large amount on home office setups, fit outs, technology purchases, computers. I think if we go along and look at actually the earnings reports of companies like Temple Webster, JB Hi-Fi, Harvey Norman, they've reported remarkable increases in revenue over the last 6 months due to this. So it's no surprise that these imports are coming in from that adapting workforce. The next slide is just reflecting on household income and consumption, and consumers are saving more. So when we look at this graph, and I won't obviously dive too deep into it, but the graph is a good reflection on whether the economic stimulus we are seeing is actually hitting Main Street. So that Main Street just being, your retail stores, coffee shops, those sort of things, or a mum and dad saving this money. We can see that consumption is beginning to decline, has done so for a year, but into 2020 has taken a further steep drop when we look at consumption, which is no surprise given COVID-19. While disposable income has increased, we notice that the spending hasn't increased either. So that's a reflection there that obviously disposable income has increased, consumption hasn't, and therefore we're seeing this saving ratio take a bit of an uptick there. It doesn't sound like a lot in terms of what we're saving right now when we look at the fact that our saving ratio is 5% of our household disposable income, but considering leading into GFC and pre-GFC, we weren't saving any. 5% is actually a fair bit. And if we look at obviously the GFC results, we can see that a lot of people were afraid to spend, not a lot of people spending at all, or hitting Main Street. So the fact that we're doing 5% is okay. I suppose when we look at the reasons why people are saving and we make a comparison to, I suppose, the United States, we can compare that a recent report that was released by CNBC, there's a similar report to this, actually, a similar graph. And funnily enough, it showed that Americans are saving on average 33% of their disposable income, which is huge. And it's just a reflection of the huge gap between cost of living in Australia being quite high compared to the cost of living in the United States being quite, I suppose, reduced compared to our overall living costs. Regulators at the moment are really going to have an issue right now trying to get people spending. They need to present that they have this under control, that there's a vaccine on the way to keep, I suppose, consuming spending up and also to improve the local economy. When we move over to the next slide, we'll just have a look at how reliant we are on China. This is just a reflection of our exports. So at the moment, with respect to Australia, we're an export-driven nation. Surprisingly, from an economic point of view, we're actually treated as a third country due to the fact that we're so heavily reliant on our natural resources for an export point of view, such as iron ore, LNG, beef, as well as things that might cause a bit of an issue in the future is this talk of trade wars, such as more recently we saw a lot of issues around wine exports, barley, sugar, those sort of considerations with China. If we go through a bit of a process with China, especially with the US as well, going through the trade war, especially with Donald Trump, he might decide to start kicking stones at the US if there's signs that he might not be, I suppose, having enough support to beat Biden, then it's likely that we'll get dragged into this as well. and it's going to cause maybe some potential short-term issues around that. Scott Morrison, he's been quite vocal about China's handling of the COVID-19 situation, and we know that stirred the pot as well, which could spell sanctions for us in the future with China and trade. I suppose when we reflect on just overall, if we continue our core exports to China, it'll put a bit of a crutch under the local problems we're seeing right now. More to come on this, I'm sure, with the US election in the coming months. Locally, we've also got our budget coming out in October. And given everything going on, I just can't see them not doing or touching tax reform and what that might look like. So I suppose the next slide is, how is China actually doing? Remember, they were ahead of us, obviously the first ones go through the pandemic. And we can see here that's looking at the hard data, we see the common dips experience at the height of the beginning of the COVID-19. We see electricity generation dropping, plate glass, cement, crude steel, not dropping as much, but obviously still dropping, the same with the other steel products. But obviously a reflection of when we went through the really bad parts of COVID-19 in the beginning. We can see also that China's actually, I suppose, begun production really aggressively. China went back into an aggressive lockdown initially, and it's actually paid off. You know, they're back at capacity almost, especially from an electricity generation point of view. We can take a positive from the fact that all these areas, they've bounced back, and they've bounced back quite quickly. If China is producing steel products and crude steel, then they'll have a raw demand for Australian ore. You know, that's a positive for us. If their electricity generation is ticking up, which it is, then this also translates into a positive for Australia due to their natural need for our coal. So again, we can take positive from this, that at the core of our exports to China, if that remains solid, that will help keep our local economy buoyant in the meantime. The next slide we'll move into is unemployment. I'm just going to take a quick drink of water just as we go through it all. Unemployment. Unemployment's a tricky topic because technically there's two types of unemployment rates within Australia, and it does cause some confusion. At the moment, there's the official rate. Now this is, at the moment, people who are registered for the job seeker classification and they're collecting their entitlement. So they're not employed at all, and nor were they previously. Then there is this unofficial unemployment rate for those that have not been registered, as well as those who are on the job keeper package through their employer, but are currently doing 0 hours. So there is a bit of a difference there. The job keeper is a scheme used for businesses to keep their employees on payroll, and therefore once some normality returns to the local economy, they'll be back in the workforce just as quick rather than having to search for a job. And that's why businesses are being incentivized to keep their employees on payroll through the job keeper scheme. The unofficial employment rate actually hit about 15% back in April and is coming down gradually and is roughly about 11%. However, given the lockdowns in Victoria right now, we do expect that to trickle back up over the short term as Victoria handles their stage 4 lockdown. At the moment, the RBA expects the unemployment rate to continue to increase over the rest of the year. An unusually large fraction of people did not actively look for work in April and May because there are in many cases simply no suitable jobs to apply for during the period of activity restrictions. So they are recorded as having left the labour force, not as unemployed. As job opportunities become more evident, the RBA expects that many of these people will start actively looking for jobs again. This increase in labour force participation is expected to outpace any recovery in employment. This next slide. Sorry, ladies and gentlemen, I'm just going to pause. I'm just getting a few comments that a few individuals can't see slides. Just want to reconfirm, raise of hand, you can hear me, you can see the slides, you can see me as well. Thanks guys, plenty of you coming through with that raise of hand. Both these recordings, myself as well as the one that Brett put on last night, they are going to be available on our YouTube channel, and anyone that has registered for them will actually be included in that as well. So just bear that in mind, that the recordings will be sent out to individuals that have previously registered. Moving into the next slide, talking about unemployment. So high unemployment may persist, and this is expected given everything going on right now. It's nothing new. It's not a surprise. The graph is based on the official rate, so that's the registered individuals for job seeker classifications, and they're receiving their Centrelink entitlements. So as we can see here, they're expecting that the rate on a worst case scenario will go above 10%. Again, on the official rate, not the unofficial rate, in the later part of this year. On a conservative basis, we can see it's still getting up to about 9.4%, and we can see there a bit of a middle ground there, just about 9.8%. So what they're forecasting at the moment is towards the end of the year, 1 in 10 Australians are expected to be registered for unemployment benefits through the official unemployment rate. So obviously some concern that we are still seeing the effects that the unemployment rate is going to keep rising. In a recovery phase, they are expecting that this is going to flesh out and push out to 2022. And even then, it's still going to be above 6%. So still some time away. It's really going to come down to how quickly the government can fire up the Australian economic engine, get people going back to work, get people spending. Again, when we looked at that first graph of the flash PMIs for the private sector, which just is an overall measure that we use of how the local economy is performing. At the moment, corporates aren't spending. They're not, they're keeping their capital expenditure low. It is really going to come down to what the government can do to ignite this flame, to get the economy back up and running as quick as possible as well. So there's less drag on the overall Centrelink entitlements, and how that's going to look from a rolling back point of view as well. Next slide, or next, I suppose, agenda item, going to tax residency. So pretty important topic right now, because we're seeing a lot of case scenarios where individuals, they might have been given the opportunity, okay, you can go back to Australia, you can still work from home, and then you can return. That was really common through the periods of February, March, and April, people returning for several months, self-quarantining, staying home, working from home, being on sort of their overseas employers' schedules. And we were really surprised, but the ATO was on the front foot with that in terms of guidance. And I suppose when we go back, ATO, again, they're on the front foot. They released guidance about March and April of how these individuals which were forced home, who Australians that are normally overseas residents but are forced back to Australia for a period up until 30th of June, would still be able to treat themselves as foreign residents, and therefore that income that they're receiving, foreign sourced income, would not be treated as taxable in Australia. So that was really good to see. But they only provided guidance initially up until 30th of June. And then obviously recently they provided some further guidance for those that are still stuck here, given those circumstances. So let's dive into it together. So the Australian Taxation Office has recently updated its guidance on employees who have found themselves temporarily displaced in Australia. As part of the initial COVID-19 concessions, the ATO advised that foreign employers do not need to register for PRYG withholding where their employees are temporarily working in Australia solely as a result of COVID-19, provided they intend to leave Australia by 30th of June 2019. Now, depending on the country in which you ordinarily reside, that might be impossible. They might have shut the gates, which is quite common, especially through Southeast Asia, where they're not letting individuals back. You have to apply and apply again, and even then, you're lucky if they let you back. Now that foreign employers and Australian employers have had sufficient time to consider and take stock of their displaced employees working back in Australia, the ATO has updated its guidance to be clear that from 1 July 2020, where employees continue to work in Australia and the employment income is assessable, the usual employer obligations will apply. So just to touch more on that first point, pulled from the ATO's website, if we're starting to do work for our overseas employer, but they have a local Australian subsidiary here, and therefore we're starting to receive entitlements like superannuation guarantee, those sort of considerations. Even though it might be short term, now that we're in a new financial year, there may be some tax implications for this, especially if you're going to leave again. It might actually have an impact on treating you as a normal tax resident again, which when you look at sort of your worldwide assets and everything, it's going to change the treatment of your assets as well. So it's important to take stock of that situation. If your situation has changed, you're now employed by the local Australian subsidiary, how that's going to impact your residency in the short term as well. While there is still relief where an employee continues to be non-resident of Australia for tax purposes, and the work that they're performing in Australia is truly foreign sourced, This will be dependent on the individual facts and circumstances of the employee. So again, individuals that are still stuck here, they're still employed by a foreign employer, then based on those individual circumstances and facts, especially when we factor in the tax residency rules, they may still be able to be treated as a non-resident for the period leading into the end of December. When we look at just the overall tax residency tests, there's 4 tests. So the primary test is the resides test. So where are we residing permanently? And then we feed into the 3 secondary tests. It's the domicile test, the 183-day test, as well as the superannuation test. The superannuation test is usually only reliant if we're being seconded overseas by the Australian government. Really common for, I suppose, individuals in the Army or the Defence Force that are seconded overseas for a 2 to 3 year contract, as well as individuals working potentially for embassies in different countries. The length of time in Australia is becoming increasingly important, as there may be employees who have spent over 183 days in Australia in a tax year and may be considered a resident under the test known as the 183-day rule. So when we look at the 183-day rule, it says that if you are inside of Australia for a period of greater than 183 days in the exact same financial year, so from 1 July to 30th of June, then that can sometimes be the test which tips us over into being an Australian tax resident. But then it also goes back to purely circumstantial as well. And that's why sometimes we need to either seek a private ruling, seek tax advice, as well as right now, given everything going around and the uncertainty, we need to keep documenting our movements as well. Even if it's email threads with our employer saying, not to return to obviously the US or whatever country it might be, to stay in Australia given the circumstances. So the ATO accepts that a person may be in Australia beyond the 183-day threshold and still be a non-resident. For this to apply, the ATO would need to be satisfied that the person's usual place of abode remains abroad and that they do not intend to reside in Australia. So again, a reminder, this is pulled from the ATO. Again, tax residency, it's a bit dry, I understand that, but that's all right, we're getting through it. Double taxation agreements. So for those that are stuck for a period longer than 183 days, still employed by the foreign entity, would be recommended to seek advice based on your individual circumstances and potential implications. So Australia's double taxation agreements provide that in certain circumstances, employment income derived by a person who is a resident of the other country after applying the relevant DTA or tiebreaker rules from performing employment duties in Australia for a short period will not be taxed in Australia. So if a contract is sent back to Australia for 2 to 3 months, DTA applies there where they're not treated as an Australian tax resident and therefore not going to have to pay tax. Generally, employment income will not be taxed in Australia if you are a resident of a country with which Australia has a DTA, you are not present in Australia for more than 183 days in aggregate in either an income year or a 12-month period, depending on the applicable double taxation agreement. Your salary and wages are paid to you by or on behalf of an employer that is not a resident company of Australia. Your salary and wages are not deductible against the profits of an Australian permanent establishment of your employer. So just some key tests there. Now this example, a really question given by the ATO. The ATO is not very helpful when it gives these examples. And again, it's on a case-by-case situation, but we thought would still provide this example. So Ian spent the following time in Australia, 15 December to 3rd of January 2020. So 20 days and then had to return due to COVID-19 from the 10th of March 2020 to the 1st of October 2020, so 176 days. So taking him over that 183 days. But again, that's across 2 financial years as well. Now, when we look at the ATO's decision here, it says, as Ian's period of time in Australia exceeds 183 days, the DTA does not apply to prevent Australia from taxing Ian's salary or wages from an Australian source in the 2019 to 20 and 2020 to 2021 income years. Obviously, this applies to individuals where their employer has a presence in both Australia and their normal overseas home. So if we are sort of being employed by the local entity, then it's highly likely, yes, ATO would treat them as an Australian tax resident, because in that circumstance, they'd be receiving your usual contributions to super, those sort of things. And they wouldn't be applying the correct withholding tax rates for a non-resident either. But I would not treat this as the hard and fast rule, this example by the ATO or gospel. It's on individual circumstances, and therefore it's important to obviously take stock of our individual circumstances, keep notes, correspondence as we go through it, especially if we can't get back home to our ordinary place of residence, wherever that might be. The next slides that we're going to delve into is just some examples of what we're seeing taking place of common, I suppose, scenarios that are playing out due to retrenchments, people being made redundant, superannuation, but more so on the topic of foreign pensions and those sort of things. So at the moment, we're seeing a lot of cases whereby, due to being made redundant, expats can access their foreign pension or a provident fund. It's usually a case where if we're given the go-ahead that, due to our visa, we need to get out of the country because we've been made redundant, then it's quite common that we can access that kind of foreign pension or foreign provident fund. I suppose an example of a common theme we're seeing develop, and it's going to continue developing, is a lot of pilots. They are losing their jobs, out of Hong Kong, Singapore, throughout the Asias, Middle East, and essentially because their residency is tied to their work visa and they've been let go, they're sometimes only given a month or two to get out of the country. So when that takes place, we notice that these types of expats returning back to Australia, they need to be aware of the risks of withdrawing the foreign pension or provident funds, as an example, because at the moment, the ATO doesn't have treatment, or I suppose there is no such thing technically as a foreign superannuation fund. The only, I suppose, governing rules around a foreign superannuation fund is the UK pensions system, where we might have to roll it into an Australian super fund by way of a qualified, recognised overseas pension scheme. And that's the only foreign pension or foreign super fund which the ATO acknowledges. But even then, we need to stay within our general rules around contribution caps and those sort of things. So in many cases, with these foreign pension fund, foreign provident fund rules, the withdrawal will be treated as a taxable distribution from a foreign trust and can be taxed at the individual's marginal rates. Now, at the moment, these kind of withdrawals, they're taxed under Section 99B, which is the foreign trust rules, which essentially says that our original contributions by way of salary sacrificing and the contributions that we receive from our employer, they make up what's called the tax-free corpus of that trust, and therefore they're seen as tax exempt. However, the biggest issue arises when we've held this foreign pension fund or provident fund, say for the last 5, 10, 15 years, and the entire growth component over those years is 100% taxable by the ATO. It's treated as assessable income. So if you're pulling out a large provident fund, and obviously a large portion of it is from the growth component, then that's all assessable, and that's when we can get hit with a huge tax bill. There's not really any relief given there. So it's important that if we are looking at withdrawing those funds, we plan around it. Very punitive treatment on those types of withdrawals. Unfortunately, the best case scenario is that we are able to draw out those or withdraw those provident funds. We send it home to Australia as a non-resident, and then we return to Australia in a new financial year as an ordinary Australian tax resident. There's been plenty of, I suppose, legal decisions or tax determinations provided by the ATO on these situations. And unfortunately, due to COVID-19, it's a common theme that we have seen developing over the last few months. So just be mindful of that, of how your foreign assets or foreign pension funds, foreign trusts, foreign bonds, those sort of things, how they're treated when you withdraw them when you're back in Australia, when you're forced home. The next slides that we're going to delve into is just property. Just going to take another sip of water, just so throat doesn't dry up. Moving into it, just a general property market update. At the moment, I suppose when we look at the clearance rates being published, they're not really a true reflection of the market due to the dramatic reduction in turnover. If we look at the ACT, the clearance rate was 87.8%. Now, normally we'd think that's pretty good. However, these results are just based off 41 properties or 41 auctions of 64 scheduled auctions, so not a lot. Now, at the moment, we aren't seeing, I suppose, a completely transparent view of the property market. And the reason being is, firstly, banks are still on those or offering those mortgage repayment holidays. Rental eviction moratoriums are still in place. And we're also noticing that Victoria is looking to extend these until the end of the calendar year, so up until the end of December, given the lockdown that they're in right now, as well as some banks are still looking at working on repayment holidays with certain individuals on a case-by-case basis based on that 6-month period. Now, with those repayment holidays, those repayments that aren't getting paid now, they will need to be repaid. And it obviously means that it's highly likely that the overall principal amount will increase and can actually reset those loans as well. At the moment, we're anticipating the fiscal cliff. It's likely to occur later this year or next year, depending on when the government decides to roll back the JobKeeper payments, job seeker payments, these rent relief tenants given to, I suppose, current tenants with the moratorium, as well as the bank mortgage repayment holidays as well wind up. So it's unsure how long that's going to keep being extended, given everything going on. But we are going to see a fiscal cliff. It is going to happen. It's going to happen either towards the end of the year or next year. Some recent news that came out, NAB about 2 months ago, they looked at sort of the modelling around the property market in Australia, and they said worst case scenario, over the next 3 years, the Australian property market is expected to pull back by up to 32.78%. Now, that's obviously an average. It's not specific to certain areas, but as an average. So that's significant over a 3-year period. So it just goes to show that the property market takes a very long time to price in the kind of negative impacts of these events. We have to remember that, again, that when we look at banks, the big four banks, all banks, they're at the coalface of consumer behaviour. They get to use their data, as well as the AI analytics, and they can forecast customer behaviours on being able to, their spending habits, making mortgage repayments, credit card repayments, and therefore, if we're seeing predictions coming out of the big four banks like this, we really do need to take stock of it. Banks are reaching to gauge out to clients at the moment to sort of gauge who can make repayments, who can't. Therefore, when we're hearing these kind of announcements come through, it is a bit alarming. And there was a recent announcement made by the NAB CEO, but I'll introduce that very shortly. This next slide is just obviously a comparison of housing prices and household debt as a ratio to household disposable income. When we look on the chart on the left, the household prices relative to household income, we see that obviously there's a bit of a peak there, looking back at the start of or the end of 2019, getting up just above 5 times disposable income. So just looking here. We compare that to the right chart where household debt obviously continues. It's on a clear path here where right now it sits at about 1.8 times disposable income. At the moment, our concern is that we're going to see a pullback in household prices, but we're not going to see a pullback in household debt. Australians have struggled over the last 2 years to meet their repayments on their debts, and therefore there is a concern of how this is going to play out over the next 12, 18, 24 months. When we look at, I suppose, household income over the last few years, this is mainly caused by wage indexing. It didn't work. We saw wages actually pulling back due to the rise in the cost of living, especially in the capital cities, as well as the rise of cost on taking on more debt. We now obviously have a scenario, as said, where income is dropping due to the pandemic, household debts remain the same, and also household prices contracting as well. And that's the big concern as well, how long it's going to take to really see the impacts of this. This next slide is just discussing on the NABCO, as I mentioned. So this was concerning when it came out, obviously a media release based on a teleconference from the NABCO as a reflection of where we see the property market going. I'm just going to try and paraphrase and read out the quote. There will unfortunately be some situations where it's better off for people to actually sell up and start again so they can take some equity out of the situation. So what the NABCO is saying that, okay, we expect the property market's going to actually contract, there's going to be a pullback. People have an opportunity now to get out, clear their debt, and still walk away with some equity, some capital proceeds, some cash proceeds from the sale of that property. If they wait too long with the property market expected to drop, there is going to be an equity, and we could have a situation where a lot of individuals might go into negative equity. So that's the biggest concern. I was speaking to Brett about this quote a little while ago when it came out, and I suppose when it came out about 2 weeks ago, he hasn't seen anything like this before. One of the big four CEOs announcing this in his 24 years in being in the industry, and it just is a true reflection of sort of what you call uncharted waters right now. Another quote which was recently seen, I suppose a view from the coalface, was another example of CBA. It's having conversations right now with customers on whether they should be considering downsizing based on their loan to value ratios. Are they over leveraged as borrowers, especially from an investment point of view? And at some point, if nothing improves, holding all else equal, and it just keeps getting worse and worse, banks will lose patience with investors and their borrowers, and therefore they'll either consider forcing sales to either offset these loans, or we might even see mortgagee repossessions. It's not going to happen overnight, but we might see it start to happen over the next 6 to 12 months. The next slide just goes into mortgagee defaults. They're on the increase, which is obviously quite obvious. This data came out in August, so there's a bit of a delay. It's actually reflected of the March quarter, again from the RBA as well as APRA. I'd like to still focus first off on just the right-hand side. I don't want to worry about this side, just the right-hand side. It's a graph I've shown before to some clients in a client-only webinar. But at the moment, we're seeing that the right-hand side is a reflection of the bank's non-performing assets, otherwise known as people not paying their loans. So obviously we notice we've got the business side, we've got personal, we've got housing. Now, when we look at the business side, we notice the dramatic spike which happened through the global financial crisis, so the GFC. Now, the reason why we haven't seen a business spike again is because a lot more businesses, they've learnt from the GFC, they're running a lot leaner when it comes to their overall gearing. The business models have adapted, and therefore the businesses, I suppose, overall haven't seen a spike as drastic as what we would have seen, obviously, back in the GFC. And we probably won't, given that the banks have been quite good with businesses. Right now, probably the biggest concern is the housing is at 42%. During the peak through the GFC, remember that defaults were only at about 0.8%. Now, we're still going through this right now. We're still going to really see the impacts of, I suppose, mortgage defaults over the coming 6 to 12 months, and we're already at 1%. And this is taken from March quarter, so not factoring the last few months. We notice, obviously, June, July, we had an expansion economy, but now we've obviously had that contraction through August as well. So it's going to be interesting to see what takes place over the coming months to see how these mortgage defaults play out. There was always pain in the property market, obviously leading into before, I suppose, COVID-19, winding up the end of 2019. But we're really going to see this number increase on, especially when rental evictions relief comes to an end, as well as the repayment holidays come to an end. So it's something to monitor. Ideally, we'll know more come October of the previous quarter, given when the RBA and APRA release these graphs and this data. Now, discussing vacancy rates on the increase. Obviously, one of the major concerns is obviously that they are on the increase. They're going to continue increasing, but we're also noticing a shift in the sort of current rental property availability market. Now, at the moment, many people, they did change their living arrangements in recent months to save money during the period of lockdown, which makes sense. The decline in international visitors and domestic business travellers because of the travel restrictions has also encouraged some landlords to offer their short-term rental accommodation on the long-term market, such as your traditional Airbnbs. People aren't holidaying anymore. If border restrictions stay in place, then obviously we can't go interstate for these kind of Airbnbs, and therefore there's a lot of stock on the market right now. That response obviously increases the vacancy rate and available rental stock. As a result, rental vacancy rates have increased significantly in Sydney and Melbourne, as well as many tenants have attained discounts on their existing rental agreement. Advertised rents have also fallen of late. We expect that demand for rental housing will remain weak for a while yet, while we're still going through it all. The next slide is just some raw data and not something you'd usually hear, I suppose, from your local real estate agent, but it's a good reflection, again, especially on these capital cities. So we can see from this graph a common theme is developing. We notice right now, obviously, that vacancy rates are on a significant incline. They're increasing. Obviously, if we look at a bit of a pullback here, it's obviously likely due to the fact from the data June, July, a bit of a pullback going into now this Victoria, but we are expecting that these will increase. Another concern is you've got vacancy rates increasing, but you've also got rental yields contracting, people not being able to pay their rent or people negotiating discounted rent. So many Australians, they've always been encouraged to over leverage themselves when it comes to property investing. They've followed too often this negatively gearing scenario where, you know, a bit of capital growth on the property, we draw down on the overall capital, we use that to funnel into another property. And it's likely a case where, you know, some individuals, they might have 4 or 5 investment properties which are highly geared. You know, their loan to value ratio before COVID-19 might have been anywhere between, say, 65 to 75%. If the market pulls back over the next 3 years, in terms of that 32.78%, then we're going to see a very interesting scenario play out where rental yields have dropped, as well as disposable income has dropped. But we've also got a case where some individuals are going to be in negative, I suppose, negative gearing or negative equity, I should say, sorry, negative equity scenarios where now the mortgage is worth more than the property. And therefore, the real pain hasn't really been seen. We'll probably see it over the next, again, 6 to 12 months. If we move over to the next slide, we're actually going to have a look at loan deferrals. They're increasing, and right now they are a bit of a concern. At the moment, we look at the total deferred loans as a percentage of the total loans. So right now, at 10%, all loans are being deferred. So 274 billion of 2.7 trillion loans are deferred right now. The housing sector has 194 billion loans out of the 1.8 or 11%, while small business almost 20% or 1/5 of loans are on deferral. So as we can see, we aren't talking about small percentages here. They are going to keep rising over the coming months, and banks are being very vocal with their business borrowers to come to agreements about repayment terms as well. So definitely watch this space, and ideally we'll be doing another update towards the end of the year to see what this data reflects. Continue on from the loan deferrals, again, still a concern when it comes to how these loans look. We can see from the charts that April, there was a huge spike of a new approved deferrals. May, obviously continuing on with the trend, still more, and these are the billions of dollars. June, still more, but obviously a lot of states had some normality through June, July. So therefore, we're seeing that existing deferrals were obviously, or exiting deferrals, I should say, people actually paying their mortgages again, which is good to see. If we look at the chart on the right, this is probably what's concerning. Almost 9.2% of housing loans on deferral are from a house with a loan to value ratio greater than 90%. So this is this graph here. So that's concerning given expectations in the property market. We've got 9.2% of housing loans on deferral, and they're coming from houses which the value of their loans are almost equal to the value of the property. So it's not going to take long for those individuals holding those loans to be in a negative equity situation. It's probably why the NAB CEO raised those comments, people taking stock and taking equity now rather than in 12 to 18 months when the equity's gone. And they sell the property, but they're still going to have a loan to pay out. I suppose when we look at the property falling into negative gearing scenario or negative equity, sorry, we almost also see that almost 15% of loans on deferral are interest only. So not even winding down the principal component of the mortgage, very common. That'll be an investor's loan paying interest only, where interest only, that's very common for your negative gearing scenarios. You know, we're just banking on the fact that the property value will increase over you know, a 3 to 5 year period, and then we can draw more equity out of it. We're trying to build up that negative gearing but passive income scenario. If we look at total housing loans, 5% again overall that are deferred, coming from that equity scenario of more than the loan to value ratio being more to 90%, very concerning, as well as 36% are coming from investor loans as well. So this data, it's very sobering, I suppose, to look at the whole scale eating into the property market over the next 6, 12, 18 months, depending on how long this will play out. This next slide, it just discusses of when, I suppose, your pure investment property or investors in investment properties sort of left the market and obviously left the building in 2018. And you can see that here when we compare it to owner-occupier versus investor and housing credit. So the increase of those loans for those specific investors versus owner-occupied loans. So as an example, we can see here that there has been a bit of a retracement or retraction over the last few months, over the last 6 months, given everything going on. However, owner occupier, it's still holding at 6% growth, whereas investors have contracted. They're pulling back. They're now obviously in a point where it's negative. It's decreasing year on year, or I suppose semi-annually. Banks have put blocks on certain postcodes as well, based on the bank's internal LVR. I know some suburbs in Brisbane where the bank just won't lend any money due to the bank's internal loan to value ratio and how much debt they have based in that suburb or that postal code. So that's a concern as well. But that brings our property market update to a close. Moving into investing now. I'm mindful of the time, so I'll keep pushing through it. So a good quote here provided by Sir John Templeton. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. I suppose it's just a reflection that investment markets, they start at the next phase of when it's the worst case scenario or the worst possible time. Probably the best analogy I can make for that is it's always darkest before the dawn. What's good about equities is that they react straight away to events like this. They're able to price in risk immediately and also for a worst case scenario. And that's the sell-off that we saw at the beginning of the year through February, March and April. At the moment, we're just winding up reporting season, which commenced at the end of July through the end of August. Overall, we've actually been, I suppose, quite happy with reporting season. Nearly 70% of the market has now reported on their 30 June results. 67% of companies reporting falling in earnings and 53% cutting dividends. I'll reflect why overall we're okay with the results. 10% of companies have suspended the dividends, which is surprising. Thought it would have been more, but given that the way companies have adapted, that's quite good. Again, to us, this isn't a bad result. This isn't a bad result, I suppose, considering what we're experiencing right now. Companies in the past running high gearing levels pre-global financial crisis, most companies, they were geared anywhere between 60 to 70%, and they've learned from these mistakes. But going into the pandemic, companies were running at a gearing scenario of 25 to 35%, so running a lot leaner. Obviously, if companies were running at pre-GFC gearing levels, the outcomes would have been significantly worse. So it's somewhat been a bit of a savings grace that companies have learned to operate in I suppose, a leaner manner from a gearing point of view. This is an interesting chart, and it's a reflection of the ASX 200 over the period going from when Corona first started. So the ASX 200, it's made up of the top 200 market weight companies, your typical blue chip companies like your BHP, your Woolworths, your Coles, your big four banks, obviously your mining stocks, all those sort of ones, as well as healthcare stocks as well. We can see on the left here a significant drop, which was felt by the local market just due to the news on coronavirus going through obviously the beginning of March, about I think it was the 24th of February roughly, and obviously dropping very quickly. And it's mainly caused by obviously a shortage of US dollars, as well as the risk of not knowing where this was going to go, and therefore reflecting that equities price in risk immediately, within nanoseconds. We then see through the period of April, May, a bit of a relief rally. So people are noticing that things look cheap, so they're jumping into the market quite quickly. It's a pragmatic approach. However, it also reflects that companies may look cheap, but they might be really feeling the pinch for, I suppose, the next 3 to 5 years. So it might not be the smartest decision. We noticed throughout the period of what we would call, I suppose, a bit of a inverted flag pattern taking place between the periods of April and May, which is just this. Obviously we notice that there's this relief rally taking place, finding new highs, but obviously not a new low, which is good to see. And then as it winds out, we notice a compression in the market. When we look at since June through up until probably about now, actually, now that we're going through earnings season, on average, the ASX 200 has actually held up pretty good. Hasn't changed too much. Hasn't sort of broken through support, but it's stayed at a similar level. I suppose through May to June, when we look at the market through this period, the market has mainly sort of come through there based on the stimulus package, investor sentiment, and just general announcements from companies as well. Since late July, throughout August, we have been going through a reporting season, and therefore the market hasn't really embraced this. A lot of blue chip companies are actually releasing a lot of their results early before they needed to, and therefore their share prices had already built in this reduced earnings guidance as well, which was good to see. Most companies have been resilient, so this is just a reflection of Australian profit results relative to market expectations. Percentage of results. So at the moment, we can see here that 28% of companies thus far that have reported actually beat expectations from a profit perspective, whilst on the other end of the scope, 27% reported below expectations, whilst the remainder remaining quite flat and on par with expectations. A great scenario considering the erosion of investor confidence in the beginning from February and March, and I suppose now that we're seeing that the ASX 200, it's staying pretty much on par with what it's been doing, trading places day to day, it hasn't eroded this investor confidence. Whereas you compare back in March and February, we had obviously a huge weight of sellers, but a complete absence of buyers when Corona first came out. Dividends have held up reasonably well. So again, another graph, Australian dividends relative to a year ago, and this is a reflection of what has done so better compared to last year. So 28% of companies have increased their dividend, which is great to see. And I suppose when we look at the average dividend of an ASX blue chip, about 4.2% is the income yield we generate. Now, we compare that to the S&P 500. Their average on an income basis or a dividend yield basis is only about 1.7%. So we can understand why many investors, especially pensioners, retirees, they love these dividend yields. If they've got no view of selling their portfolio, and they're just relying on these dividends that come through, their ordinary Australian tax residents, they get the benefit of these franking credit refunds as well. We saw a 55% decrease in the dividend, which would also include that 10% of not paying out dividends for the current year as well. When we consider industries that have done well and have increased their dividends, this would be companies like your Coles, your Woolworths, some of the IT sector, some of the health sector, but we need to be careful when it comes to looking at averages. And I suppose that would sort of tie into more so of when we look at maybe just using an ASX 200 ETF and I suppose the overall weighted average or weighted cap of that investment and how it is treated, especially when banks aren't performing anymore. When we looked at a lot of individuals, a lot of people were buying up Qantas in the beginning through obviously March and April, but just be mindful that Qantas is in the thick of it right now, given that they've just let go 3,000 jobs, they're outsourcing, and therefore this isn't going to be translating into any dividends paying out, even though they've been a quality ASX blue chip in the past. So while some stocks are cheap, regardless of obviously how they've performed in the past, it's not necessarily how things are going to play out in the near future. So just be mindful of that when it comes to your own stock picking. What's ahead in Q3 and Q4? So we're just coming into obviously the start of September. When we look at September throughout to November, traditionally a negative month. It's mostly due to a lot of companies going ex-dividend. When they go ex-dividend, the amount that they're paying out drops in their share price, and therefore we see a very slow period throughout September, October, November, as well as when we feed into December. That's actually when we usually see a bit of a market relief there, or a bit of a rally, when usually you see a lot of the big banks paying out their dividends as well. We also note that right now through September, October, November, the market feeds off what we call a news vacuum. Now, there's no big key fundamentals that are coming up for a few months, and therefore, whatever sort of the publications, Australian Financial Review, the Australian, those sort of types of media outlets are publishing, it's usually what feeds off obviously investor sentiment. And it's going to cause a bit of volatility, but we're not expecting any huge gains in the near term. The big questions also is, well, we have a US federal election taking place in the coming months. How's it going to play out? How's it going to weigh on markets? US-China trade war as well. China likely to cause more issues with the election, and we'll likely see Trump throwing some stones at China if it's seen that he's obviously not or he's losing support for his campaign bid. We should also take stock that we're having a federal budget released in October as well, and given everything going on, the deficit we're in, it's going to be interesting to see what kind of tax reform they're going to announce, because I just can't see them not touching it now. This graph, or picture I should say, is actually a reflection of the S&P 500. Now, it's a reflection of what it took the S&P 500 to grow over 3 years. And then we notice that within 3 months, it's already back at its previous high, which is concerning. One thing which is concerning is that this S&P 500, it's been propped up by these tech stocks, 5 tech stocks, and therefore it's narrow participation and isn't an overall reflection of how that index is performing. We do expect that over the next few months, immediate term, running out the end of the year, maybe even at the end of the calendar year in February, March, once we see earnings results for the full year for these companies, that there'll be a bit of a pullback in the US market. We just don't see how there can't be. This is a reflection just on local banks. So the big 4 banks, from our point of view, again, we don't always recommend buying just your straightforward ASX 200 ETF due to the underlying weights. At the moment, banks, they make up 38.5% of the Australian or the ASX 200, and therefore not all sectors are equal. This graph reflects over the last 5 years, different sectors, financials, resources, and then other sectors, starting at a similar value at 100, going back to 2014, sorry. And as we can see here, that financials, the banks, they're at a loss. So our return on equity hasn't been great from the banks, given that they're underwater right now compared to other sectors, which are still doing okay. So banks at the moment, they are carrying the bucket or the weight of the property sector, and they aren't exactly killing it right now from a profitability point of view, or a return on equity or shareholder equity. So this graph looks at the profitability of return on shareholders' equity after tax. So right now, banks have been on a steady decline when it comes to profitability on the return on equity after tax. Therefore, we're not seeing the banks as the mainstay for investments due to the return on equity declining since 1995 and likely going forward, given everything going on. When we consider the other sectors compared to banks, they will consider to have some longevity, and therefore it is important to consider these themes or thematic investing, focusing on your consumer staples, your tech, your healthcares, compared to investing just in a straightforward ASX 200 ETF due to the weights in the different sectors. Again, if you're buying an ASX 200 weighted ETF, you're going to be exposed 38.5% to financials, and this is a pretty good indication of how financials have been tracking, as well as where they're tracking right now and likely to track in the near term as well. This is an interesting graph, and it's just again, beware of averages. This makes a comparison of the S&P 5, so that's Amazon, Apple, Facebook, Google, Microsoft, as well as the S&P 495 or other S&P 500 companies. It's actually amazing looking at this graph how well those top 5 have done. If you've held individual investments or holdings in them, well done. You've done exceedingly well, especially with the recovery given through COVID-19. Whereas if you look at the S&P 495, it's done somewhat similar to how the ASX 200 has tracked over the last, I suppose, 6 years roughly. So when we look at it again, over the last 5 years, when we scramble the data, we can take away from the 2 lines. Again, S&P 5 has carried the 500 weight index, and therefore we are expecting that there will be a bit of a pullback in the US market, given that participation has been provided by these tech stocks, narrow participation. It's not across the board, across the other 495, and that's why we think there will be a pullback in the near term. And just something to consider. Whereas the S&P 495 over the last 5 years has a return on average about 7% if you're considering dividends as well. I'm now just going to move into the Q&A. There's a few questions that have filtered through, which is good. Thanks for sending those through. But if you have general questions about tax residency, own situation, general items, happy to address them. I'm just going to take a sip of water and just start going through these questions, and I'll announce them and read them out as we go. Thanks, guys. Just dropping in now. I'll just try and do this one. So Jason, what is your recommendation for how to deal with the foreign super tax issue? So again, that's just referring to the issue around if we are made redundant and we're forced to leave the country, we can technically take these foreign provident funds. Ideally, as I said before, the ideal situation is that we are withdrawing these funds while we're still overseas. We haven't returned, we haven't domiciled ourselves back in Australia, and we are able to send it back in a tax year now and then return in a new tax year. Obviously, given everything going on, that's not necessarily possible. So firstly, I would always seek some guidance from a licensed, I suppose, tax advisor or tax financial planner on the assessment of the growth of that foreign provident fund or pension. So obviously grabbing a statement, having a look at the overall growth of that and making a comparison between what is made up of your contributions as the employer and what's made up of the growth component to give you a rough idea of what might be treated as assessable income in the eyes of the ATO. The other consideration is that many accountants, if you send those funds home prior to you being back in Australia, filling out that entry card, then they will still treat it as a withdrawal. But obviously, because you were a non-resident at the time that you withdrew it and it's already back in Australia before you arrive, then they'll treat it as not being taxable. It is a case-by-case scenario because some foreign pensions, they won't allow you to withdraw the full lump sum. It might only be a component. So it's best to seek, obviously, personal advice on that. Some other things that will assist with winding down assessable gains or assessable income from those foreign trust distributions, being the foreign provident funds, is right now we're in the third year of where we can make and use what's called a concessional contribution with super, or the catch-up concessional contribution. If our superannuation balance is under 500,000 and we haven't made any concessional contributions or received any super guarantee contributions from our overseas employer, then we can use that as a way to offset that assessable amount. But again, it's on case by case, and it's best to get an assessment on that individual situation. So that's the best way that I can sort of address that question. Just going through some more questions, just bear with me. Jason, I hope that addresses your question. Come back to me if you've got some more. There's a question here, Mark. With the DTAs and employment income not being assessable, is this just for non-residents? At the moment, yes. If you're in Australia, you're still being treated as a non-resident. It might even be the case where your wage income is being received over in your Singapore bank account, Thailand, maybe even the United Arab Emirates, depending on where you're usually domiciled. Then yes, at the moment, the ATO said yes, you'd still be treated as a non-resident. However, it is on a case-by-case scenario. So if you're unsure, firstly, worth contacting an expat-specific tax accountant. If you're unsure and you don't have one, let us know. We've got quite a good suite of them, as well as, maybe if your situation is very grey and hypothetically you're stuck here until past December at the end of the year as well, you might need to even seek your own private ruling because perhaps you can't even leave the country to enter your other country, which you're normal and ordinarily a resident of. Just going through this, an individual that they've announced the question, but they've had to leave. I'll do my best to just address it because I think we can all get a little bit more information out of it. I'll just see if I can drill down on it. So this one's about okay. So if we cash in on investments, we risk taxation. How does the 10-year rule apply, in inverted commas? Now, this question, Andrew, thank you for the question. This is mainly specific to those foreign investment bonds, commonly sold over in the Middle East, throughout the Asias, where they sell it as a bit of a tax-free wrapper. We have investments in it. We'll have maybe an ongoing savings plan. If we try and access the capital early, we're charged with huge, I suppose, fees or a percentage of the original capital that we put in. If we hold it for 10 years, they say obviously it's tax-free in that local jurisdiction. Now remember, that's not always the case with back in Australia, because remember, there's thousands of these types of offshore bond products. And in order for the ATO to provide an assessment on that, it would have had to legislate the similar rules. So I would say that based on that, Section 99B might apply to these foreign investment funds that we might withdraw whilst we're residing in Australia. Alternatively, you could seek a private ruling from an accountant. They could look at the ongoing contributions that you put in the assessable earnings and see if there's any credits or imputation credits you might get the benefit of based on the internal, I suppose, tax treatment. Funnily enough, a lot of these types of investments, foreign bonds, they are sold actually in tax-free zones. Very common in the Middle East. Let's put you in a bond, let's lock you up for 10 years, and then it's highly likely we're not going to be there for 10 years if we're moving around, we're an expat. So it's a good way for that sales consultant to lock you up. So just be mindful of that. You don't need to invest in those kind of things when you can just invest in direct shares, ETFs, those sort of things back in Australia. If you're in the US, be mindful of investing in ETFs, managed funds, LICs, Australian Real Estate Investment Trusts, because they are treated as what's called a passive foreign investment company, and it's highly likely you'll pay a higher rate of tax on those. So seek advice before investing back in Australia if you're in the US around those type of investments. Just an item here from Stephen. Given your assessment of property, do you see an investment opportunity? If so, what would you suggest as a good strategy to prepare and make the most of this opportunity? Stephen, more than happy to have a call about that. You're a client, so we'll go into it. Can't really give specific advice on that. It's more the personal side. Obviously, there's we're seeing a contraction in the property market. If you're looking at investing, you'd be best being patient right now. Buying right now is probably not sensible given that it's expected that we're still going to see it contracting over the next 12 to 18 months. You then also got to assess your time horizons, your risk profiles. How long are we looking to invest in that property specifically? What kind of risk are we taking on when doing so as well? And what kind of gearing are we going to have on that property as well? Is it proving a point from a tax point of view? Another question here from Jennifer. G'day, Jennifer. Given the outlook for property, if you're planning to return to Australia in the next 5 to 10 years, what are the advantages and disadvantages of buying a permanent place of residence in the next, say, 12 to 18 months versus waiting until you're a tax resident again? Really good question. A few things feed into that, so happy to go into it because it's mainly about tax treatment of different assets when we're a non-resident. So right now, for a non-resident, and let's say we're buying a property which in the future, it will be our main residence, but right now we're going to buy it, we're going to sit it on the shelf, we're going to rent it out, get it tenanted, have a loan on it, it's treated as an investment property. Now, because we aren't able to move into that property straight away, we cannot establish it as our main residence. And therefore, there's always going to be a bit of capital gains tax, which will accrue on the property at some point based on our period of holding it and our period of being a non-resident as well. So it just means that 12 to 18 months of holding it, it's always going to attract some sort of capital gains tax. And later in life, even if we live in that property for the next 5, 10, 15 years as an ordinary Australian tax resident, you would still need to declare that transaction to the ATO. And therefore, depending on the capital gain over that kind of time period, we still might have to pay a bit of tax. Also, property as an investment, when we are a non-resident, we do not get access to what's called the 50% CGT discount concession. So as a normal Australian tax resident, if we buy an investment, whether it's in direct shares or property, we can hold that investment for up to 12 months. After that 12 months, if we sell it, we only have to pay tax on 50% of the capital gain. While in this scenario, it's apportioned. That 12 to 18 months, we won't get the discount at all because we've held it as a non-resident. There's also other considerations around the gearing on it, as well as from a tax point of view, is it going to be positively geared? If it is, then our income tax rate on that would be 32.5% on the first tier as well. So it's important to take stock of the different strategies, whether it's important or not, and whether it's relevant. Another question we've got here is, we recently sold our property in April 2020 prior to the main residence exemption transition period coming to a close. Currently we're sitting in cash. Should we look at sitting on the fence, investing in a term deposit, or putting our capital into direct shares? So just a bit of background, the main residence exemption, it was abolished in 2019, December, for expats. So what that means is if you sell your main residence now as an expat, as a non-resident after 30th of June 2020, you'll pay capital gains tax on that property all the way back until the day that you first purchased it. So the period that we lived in actually accounts for nothing. A bit ridiculous, but that's the new legislation that's come through. In regards to cash and where to sit it right now, well, if you're obviously looking at an overall strategy, and you're focusing on key themes in the market, depending on your time horizon, if you're investing for a minimum of 4 or 5 years, you could consider drip feeding it into direct shares. However, it does depend on your goals, your risk profile, and essentially just the level of risk and how risk adverse you are. And then you can look at diversing your portfolio across just sort of key themes as well, focusing on those quality sectors which are going to keep producing good results. While those questions just still come through, I've just put our contact details on the screen. If you have any questions about your own situation, we do offer free initial consults, 30 minutes, either depending on where you are, it'll be with myself or Brett, and we just pull apart your situation, especially if you've got any specific questions as well. So you can email us at info@atlaswealth.com, or alternatively, you can submit just an online inquiry via our website at www.atlaswealth.com. If you haven't liked our socials, we are on there. So feel free to like our Facebook page where we release all our blog articles, and when these kind of things are taking place, we're on LinkedIn, Twitter, as well as Instagram as well. And that's obviously where we feed out our episodes of Expat Chat with Brett. At the moment, so I might just address one last question here. With this question, it's mainly about renting out a property. However, because it's been negatively geared, I haven't been lodging tax returns. While I need to lodge a tax return, I've been overseas for the last 8 years. Regardless of the gearing on the property, if it is still producing some sort of income, even though on paper from a tax point of view, let's say it's been producing an income loss. So therefore you'll have carry forward losses there, which you need to account for. So yes, if you've got that many years where you haven't lodged a tax return to account for that income, even though it might be running at a loss, yes, you do need to get it addressed. Matthew, I'd recommend just reaching out to me. I'll put you in touch with a good expat accountant, and they can assist you with that. Again, remember, if we haven't lodged these kind of tax returns and it's been negatively geared for that whole period, essentially, you've got probably quite a large carry forward income loss, which you could treat as a tax asset. So in the event you had to sell that property and you're making a good capital gain, because you're a non-resident, you pay actually a high rate of capital gains tax, as well as you don't get access to that 50% CGT discount concession. So by having an understanding of what your carry forward income loss is, just allows you individually to do some personal, I suppose, wealth management planning, tax planning. That way, if you want to release that equity, release the proceeds, and pay out the loan, and then do something else with the capital, or just sit on the fence sitting in cash, then there's a bit of an idea. I might draw that to a bit of a conclusion now and wind up. Thank you all for attending tonight. I greatly appreciate. At the moment, in terms of the registered applicants and who's attending tonight, we're actually spread across 46 countries. So very grateful for tuning in. I know it's either going to be early morning, late evening, afternoon. So very appreciated for you tuning in. Again, if you have any queries or concerns, please feel free to contact us on one of our socials, or via our website, via an online inquiry, or alternatively just at that info@atlaswealth.com email. In the meantime, stay safe, stay well, and we'll speak to you very soon.